The Johnson family study. John Johnson and Mary Johnson. John Johnson is 24. He graduated BYU in 2016 with a degree in actuarial science. He currently has a full-time job as an actuary. His wife, Mary Johnson, is 25, graduated BYU in 2017 with a degree in sociology. She is a full-time graduate student and a part-time nanny. They currently have a monthly income of $4,800. They are looking for a home. Their home wish list is to have at least 2-bedroom, 2-bathroom in the metro Atlanta area with good public schools nearby, public transportation, and nearby parks. They have, in looking at the family budget with a monthly income of $4,800, they're able to put $500 into long-term savings, $400 into short-term savings, and they could pay a maximum mortgage payment of $1,220. Using the back-end ratio in accounting for long-term debts including student loans and tithing, the Johnson family will qualify for $1,108 monthly mortgage loan. The Johnsons looked at a pros and cons list of renting and owning. The pros of renting are they don't have any home maintenance requirements, they have less risk of unexpected costs. The cons are that rent will increase. As they are living in North Atlanta, the rent has increased at a rate of 20% each year over the past 5 years because of a new law passed that there can be no more apartment complexes built. So they know that their rent will continue to sharply increase. Another con is there's no permanence. The pros to owning is there are tax incentives as well as the pride of ownership and the ability to maintain and to renovate and to make their home how they want it. The cons are high upfront costs, the down payment, as well as home maintenance and repair costs. And then permanence would be one of the pros. The Johnsons feel they're ready to purchase their first home. They have $15,000 accessible in their 401k for their down payment with high credit scores and a secure job. But they do have only 1 month's emergency fund rather than a 3 to 6 month. Their dream home is $199,000. It would be $1,249 monthly. It was built in 1989 with 1,456 square feet, 3-bed, 2-bath, in a townhome style, easy public transportation access. There's a good high school and elementary school just up the road. It's close to work and it has a backyard. The modest home the Johnsons are interested in is $175,000, $10,097 monthly. It was built in 1978, so slightly older than the dream home. 1,225 square feet, only 2-bedroom, 2-bath, in a condo style. It's close to work, near public transportation, has hardwood flooring, and is near good elementary and high schools. As mentioned before, with a monthly income of $4,800, the Johnsons would need between $14,400 and $28,800 to reach their 3 to 6 month emergency fund goal. Right now, they have a 1-month emergency fund available of $5,000 with an additional $15,000 available for down payment. In order to reach the 10% down payment on the modest home, the Johnsons would need $17,500. Because they have $15,000 saved up for a down payment already, they need $2,500 more, which, with their budget of saving $500 a month towards their down payment, would help them reach their down payment goal in 5 months. The interest rate with a 660 credit score is 4.75%, while the interest rate with 740 or above credit score is 4.375. Every month you would pay $21 more by not improving your credit score, and over the life of the loan it would be $7,560 additional just because of a poor credit score. That credit score can be improved by making payments online, having a history of credit, as well as keeping credit card balance at a minimum. Taking into account a gross income of $57,600, along with their IRA, 401k contributions, student loan payments, and HSA, and taking a standard deduction, the Johnsons would have a monthly tax of $302.74 before owning a home. When they purchase a home, the property tax and mortgage interest would contribute to the itemized deduction along with the charitable contribution, which would increase the itemized deduction beyond the standard deduction to where it would be beneficial to use the itemized deduction rather than the standard deduction. When using that itemized deduction with the home ownership, the Johnsons would pay $247.39 in taxes every month. That is an annual $617 tax liability decrease because the home ownership deductions decreases the taxable income in the 15% bracket. The modest home the Johnsons are looking at is a condo rather than a single-family home dwelling, which means that they would need a condo rather than homeowners insurance. The condo insurance would insure the condo from stud to stud, which includes dwelling protection and personal property protection, with a $300,000 personal liability and a $1,000 deductible at $439.18 annually, which breaks down to $36.60 a month. The Johnsons share a 2007 Nissan Altima. They don't have a loan out on it, and so they are not paying interest on that. It's not a long-term debt. Their monthly transportation budget is $100, and with $50 a month going towards gas, $50 is left for car maintenance. The Nissan is working well for their needs and for their foreseeable needs, and they don't have any plan to purchase a car in the near future. With a $17,400 down payment being 10% of the modest home, the Johnsons would need to take out a $1,057,500 loan on the $175,000 modest home. With a 30-year fixed interest rate at 4.375%, the Johnsons would have a monthly payment of $786.37, $1,097 with pity, leaving the total interest paid over 30 years at $364,611.98. With a 15-year fixed interest rate at 3.875%, the Johnsons would have a monthly payment of $1,161, or $1,467 with pity. That would leave the total interest paid over 15 years at $97,160.54, which is $267,451.44 less than the 30-year fixed income rate. Sorry, the fixed interest rate. Having chosen the modest home, the Johnsons look at pity to determine what type of loan they should choose. They are putting 10% down on the home rather than 20%, which means they will need to use they need to have PMI. Based on the back end ratio, they qualify. The back end ratio we mentioned earlier, they qualify for a $1,180 monthly payment. The 30-year loan would have a monthly payment of $1,089, which is below that back end ratio payment. With the 15-year loan, they would have a monthly payment of $1,458, which is above that monthly payment. So the 30-year loan will work best for the Johnsons' needs. Once the Johnsons purchase their modest home, they will most likely live in it for at least 5 years, longer if they haven't grown out of it, it being a 2-bedroom home. If the Johnsons do choose to sell their home, based on the 5.4% annual increase, the value of the home in 2 years would increase to $194,410.30. In 5 years, it would increase to $227,636.08. And in 10 years, it would increase to $298,103.92. The Johnsons decided to continue saving to fill out their emergency fund, and as well as gain the additional $2,500 they need to reach the 10% down payment on their modest home choice. Once they have filled their emergency fund and gotten the funds for the 10% down payment, they will most likely begin with a 30-year fixed mortgage. In the meantime, in order to save up the necessary money, they will extend their lease at their current apartment and cut back on mad money as well as miscellaneous items and unnecessary clothing and groceries in their monthly budget.